Kính chào quý vị khán giả. Hello Viet TV Canada. Welcome to the Wealth Expert Show, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huang. This week, we look at the differences between RRSPs and TFSAs and which one of these you should be focusing on to achieve your financial independence and other goals along the way. Before we take a look at what we should do, let's analyze our options. Both RRSPs and TFSAs shelter you from tax as long as the investments are held within the account. With an RRSP, you can deduct the contribution from your income, which earns you a tax refund, but the money becomes fully taxable as income when you take it out. The TFSA is the reverse. You don't get a tax break on contributions, but you also don't pay tax on withdrawals either. So if you're deciding between the two options, the question boils down to whether you should pay the tax now or later. Let's look at an example to make this clearer. Suppose you receive an annual salary of $60,000. This makes your marginal tax rate 31% if you live in Ontario. Now, if you have $5,000 to invest in an RRSP, you would receive a tax rebate at the end of the year of approximately $1,500. If you invested the $5,000 in the TFSA, there would be no tax rebate. The key to the RRSP is to take the tax rebate and invest the $1,500 so that it can grow over time. The difference between the RRSP and TFSA accounts are when you withdraw the funds from the RRSP, you are taxed as income. So just because your balance in the RRSP might be $100,000, that is not the amount you will receive after taxes. Whereas with the TFSA, what you see is what you get. Now you must be thinking, how can I possibly know which one is better for me? It all comes down to planning and how and when you are going to use the money and how your retirement is going to look like. You'd probably love to maximize contributions to both RRSPs and TFSAs, but most people can't afford to do that, especially if you have a mortgage and are also trying to save some money for your children's education. So what's the best way to save for retirement if you have limited funds? The answer depends on your tax rate. If you're in a higher tax bracket when you put the money in than when you take it out, then it's better to use an RRSP. Here's why. Your original RRSP contribution gives you a nice tax rebate now, and the government takes a smaller percentage of that income tax on withdrawal. However, if you take the money out when you're in a higher tax bracket than you're in now, it's better to go with a TFSA. If your tax rates are the same when the money goes in and out, then the choices are equivalent. While that idea is simple, putting it into practice is far more difficult. After all, it's impossible to forecast what tax bracket you are going to be in decades from now. But while you can't make precise predictions, most people live on far less income in retirement than they earned in their peak working years. Here's an example. In scenario 1, say your current income is a healthy $90,000, and you believe you're on track to have an income of $38,000 in today's dollars when you retire in 30 years. In Ontario, where tax rates are close to the Canadian average, your salary would put you in a 43% tax bracket now, but you would pay only 26% in tax when you take the money out of an RRSP later. Due to having the lower income of $38,000 in retirement, assuming tax rates stay constant and tax brackets keep pace with inflation. Thus, if you contributed $1,000 plus the tax rebate to your RRSP and you earn moderate returns, you could expect that money to be worth roughly $3,165 in today's money after taxes when you eventually withdraw it in 30 years. Putting the same amount in a TFSA would net you only $2,430. So the RRSP wins in this case by a wide margin, $3,100 to $2,400. In scenario 2, if you are currently earning $80,000 today and would like $80,000 a year in retirement, you would receive more value from the TFSA due to the OAS clawback. Your $1,000 today would give you a value of $2,400 in the TFSA or $2,000 in the RRSP. The government clawbacks 15 cents of OAS for each $1 of income when total income is above $71,592. Overall, you would end up $400 or approximately 20% ahead by putting the $1,000 into a TFSA instead of an RRSP. So for well-off retirees, the TFSA wins by a solid margin. In scenario 3, if you are currently earning $40,000 today and would like a $16,500 a year in retirement, you would receive more value from the TFSA due to the GIS, or Guaranteed Income Supplement. Your $1,000 in a TFSA would once again net you a value of approximately $2,400 compared to approximately $1,060 in an RRSP. Your $1,000 contribution plus tax refunds to an RRSP will have grown to more than $3,000 over 30 years, but you would effectively lose 2/3 of it due to income taxes and GIS clawbacks when you take the money out. In this case, contributing instead to a TFSA would put you $1,370 or approximately 129% ahead. In both scenario 2 and 3, because RRSP withdrawals count as taxable income, there is a clawback on government benefits. Until June 2016, to avoid OAS clawbacks, you need to ensure that your taxable income is below the $71,592 threshold. And if you're expecting to receive GIS, you need to ensure your taxable income does not exceed $17,135. There are many other situations where you will do better with the TFSA because it is more flexible. For starters, dipping into a TFSA never has any tax impact, whereas you will be liable to pay an annoyingly large amount of tax if you need to withdraw from your RRSP for an emergency while still working. The RRSP account has exceptions to tax for first-time home buyers or education. More on this in our later episodes. Furthermore, dipping into an RRSP results in a permanent loss of the contribution room. While with TFSA withdrawals, you can put the money back after waiting until the next calendar year. Even more important, you are eventually forced to convert your RRSP into an RRIF or a RIF, also known as a Registered Retirement Income Fund, or an annuity by the year you turn 71, and then make mandatory minimum withdrawals. By contrast, TFSAs come with few strings attached when it comes to withdrawals. So if you're looking for flexibility, and especially if you might need the money while still working, the TFSA is the clear winner. An important factor to consider is whether your employer matches your contributions to a workplace retirement savings plan. So if your company tops up your voluntary contributions to a group RRSP, you should make it your priority to contribute enough to get the matching. Free money from employers is always an advantage. The only time you should make the RRSP a priority outside the workplace pension is if you are in a very high tax bracket and you are going to bring it down significantly in retirement, as in scenario 1. And if you do, make sure you don't spend the refund. This only works if you invest it. Unless you plan on doing that, the flexibility of the TFSA makes it the best default option. Looking forward, it is likely that legislation changes will raise tax rates and income-related clawbacks. Therefore, it would be safer to focus on the TFSA. Tune in next week as we discuss the factors you need to consider when picking an investment advisor. I look forward to all your email questions. Have a topic you would like me to discuss on the show? Or need a financial plan done for you and your family? Or just want some investment advice? Contact me anytime at mitch@wealthexpert.ca. Thank you to all of our viewers, and see you next time on Viet TV Canada's Wealth Expert Show. This is Mitchell Huang, your wealth expert, signing off until next time. See you then. Bye for now.